So, you have heard of exchange-traded funds, ETFs, and decided that it's a smarter choice as compared to all the mutual funds and unit trusts out there. Congrats and welcome to the club. In today's video, I'll deliver to you an actionable, in-depth crash course on all things ETFs as we'll explore how to choose the perfect ETF tailored precisely to your investment goal, whether you're looking at specific sectors, thematic trends, or any other regional opportunities. But if you just want to skip all these nitty-gritty details and go straight to investing your money in ETFs immediately, then please feel free to use the timestamps down below. So, I've been telling people that when you're choosing your ETFs, it's always helpful to take a top-down approach, starting with broader categories like country, sector, and thematic, then narrowing down to more specific criteria such as market capitalization, Shariah Compliance, and dividend distribution that matches your investment goals. But you might be wondering, why start from the country as opposed to the other way around? Well, you see, for most of us, when we were first exposed to the international stock market, especially the US, we tend to focus more on the individual companies, how they have the latest groundbreaking technology like Tesla's full self-driving, Apple's M1 chip, Microsoft's AI advancements, or just nvidia's revolutionary semiconductor chip, etc, etc. I mean, don't get me wrong, those are great, but let's not forget that all these great businesses are all built on larger foundation, the big environment, i.e. macroeconomics. Take BASF for example, the world's largest chemical producer based in Germany. Despite its dominance in the industry and a long history of innovation, when the Russia-Ukraine war broke out and triggered the European energy crisis back in 2023, the company's stock price dropped around 30% and was forced to cut 2,600 jobs. So, if you would like to bet on the overall growth and stability of an entire nation's economy instead, a country ETF may be the one you should start looking at. Let's use our favorite stock market for example, the United States. It is the world's largest capital market. Of many ETFs out there, one particularly stands out, the VTI ETF, short for Vanguard Total Stock Market Index Fund. This ETF provides you exposure to the entire US stock market as it includes thousands of US companies across all sectors, and historically, it returned close to 9% per annum for the last 10 years. Now, that is a very impressive feat for a diversified ETF, considering the lower risk you are taking. But let's say if you only want the best of the best companies in the US, there are a few popular ETFs for you to narrow down your focus, like SPY, VOO, IVV, and the SPLG ETF that all tracks the S&P 500 index, i.e. the 500 best companies in the US. Perfect for those of you who want to concentrate on the leaders in their industries and consistently deliver strong performance. Now, if you think that investing in just one single country still seems risky, no problem. Insert VT, the Vanguard Total World Stock ETF, which literally allows you to invest in the whole world's economy, spreading your investment across thousands and thousands of companies worldwide. So, as long as the global capital market grows, which it historically does since prices inflate, economies expand, and asset value grows over time, you will win. It's as simple as that. But of course, if investing in an entire country feels too broad, you can narrow down your focus by targeting specific sectors within that country. The Global Industry Classification Standard (GICS) divides the stock market into 11 key sectors: energy, materials, industrials, and so on. And each of these sectors has unique characteristics that perform differently depending on the economic conditions. For instance, during an economic expansion or bull market as we like to call it, growth-oriented sectors like information technology, consumer discretionary, and industrials typically lead the market as businesses invest in innovation and consumers have extra money to spend more on products that they don't necessarily need, like the latest MacBook or even a Tesla. I mean, just look at how these stocks or the largest technology ETF performed post the 2008 financial crisis recovery up until before the COVID-19 pandemic. These sectors saw substantial gains as the economy rebounded and consumer confidence rose. But during recessions or even economic downturns, these growth sectors often underperform. Instead, defensive sectors like utilities and consumer staples, which are more stable and are less sensitive to economic fluctuations, tend to shine right now because they provide essential goods and services that people need regardless of the economy's condition. Take the pandemic again for example. When this virus broke out a few years ago, everyone, be it rich or the poor, rushed to the supermarkets to stock up on groceries and household supplies. But do you see anyone rushing to the Apple store or Starbucks to buy their coffee? Or even lining up at LV store for the latest handbags? Not so much, right? Well, my point is the performance of different sectors is closely tied to the economic cycle. What's even better is that these days we have tools like the Moomoo sector map that show you all the sector ETFs with just one single click, making your research much easier and more effective too. Now, if you have strong beliefs about the next big trends, whether be it semiconductor, artificial intelligence, AI, or cloud computing, thematic investing lets you target those specific areas, giving you exposure to the companies that are leading in these particular industries. Plus, these themes usually overlap with several other sectors as we mentioned earlier, so you'll be getting a bit out of everything. For example, a theme like AI might include companies from the technology, industrial, and also financial sectors. Take the Fidelity MSCI Information Technology Index ETF, FTEC for instance. Although the majority of the fund's holdings are in the technology sector, it also includes stocks from industrials, financials, and even healthcare sector. And guess what? By investing in these ETF alone, we are essentially bagging all the returns from all these sectors. But top-down approach aside, if you're looking for more options that can help to narrow your choices of ETFs even further, I have 3 more bonus categories for you. Firstly, you can dive into the ETF's underlying company's market value, or as we like to call it, market capitalization. Large cap companies like JP Morgan Chase, Coca-Cola, and even Microsoft are often seen as safe havens during recessions or market downturns because of their stability, established business models, and strong financials, which make them resilient even during tough times. These giants are usually valued at over $10 billion and have weathered through various economic challenges for the past couple of decades. And while they may be more mature, they still innovate, expand into new markets, and can often deliver solid returns for investors like you and I. But also precisely because they are so well known and closely followed by all analysts, much of their growth potential may already be reflected in their stock prices. This means the good news is often priced in, which can lead to a lower upside, or as we investors like to call it, a less attractive risk to reward proposition. Now, on the other hand, small cap companies, usually valued between $300 million to $2 billion, offer a different kind of opportunity. They are usually more affordable than large caps in terms of their valuation, but also come with higher risk as they are less liquid, more vulnerable to market fluctuations and manipulations, and have a greater chance of going out of business. However, there's a reason some investors are drawn to small caps, precisely because they have the potential for exponential growth. Take Peter Thiel's $500,000 investment in Facebook back in 2004, for example. That investment famously turned into a 2000x return, cementing his status as a legend in the investing world. Now imagine if you had invested in Google, Amazon, Tesla, or Apple when they were still relatively small. Your returns today would be enormous, and that's why some people still prefer to take a chance on small caps or this popular small caps ETF, IJR ETF, betting on the explosive growth of a few standout companies. And meanwhile, mid-cap companies or ETFs such as the IJH ETF, which is one of the largest assets under management among all the mid-caps ETFs, they offer a middle ground, combining elements of both growth and also stability. They provide a balanced approach, offering the potential for growth with a bit more security than small caps ETFs. But before I move on even further, I want to give a quick shout out to Moomoo, which I'm sure by now you have seen how useful their app is for an investor, be it for ETFs or even for stock investing. And guess what? They just rolled out a new feature that allows you to earn returns of around 5% per annum without even trading. Enter Moomoo Cash Plus, a low-risk money market fund with 100% investments in short-term bonds and banks fixed deposits. It is regulated by the Securities Commission Malaysia, highly liquid, and you are flexible to withdraw your funds anytime without any penalty, making it a far better option as compared to the conventional fixed deposits. And to make it even better, they are also running a limited time campaign where you can earn a 100 ringgit cash coupon when you deposit 1000 ringgit into any of these funds. Plus, if you join now using my special code Z11, that's Z11, and deposit any amount, you will also get an extra 40 ringgit of essentially free money. So quickly before this promotion ends. It's a great opportunity to start growing your money with minimal effort. Now, for those of you who want to build a retirement fund that generates consistent passive income, has lower volatility, and even better, funds that reinvest and compound by itself over time, the dividend ETFs like the schd ETF might be a perfect fit for you. This dividend ETF usually focuses on financially strong companies such as Coca-Cola and Home Depot, Warren Buffett's favorite, offering a solid and stable returns to the investors. And guess what? Platforms like Moomoo also offer a feature to help filter high dividend yield ETFs, making it easier for dividend investing these days. However, one important thing to keep in mind though is that for most of us non-US residents, any dividends declared by US companies are subjected to a 30% withholding tax before they even reach your account, and that's a significant hit to your earnings and returns. And in contrast, capital gains, i.e. profit from selling the ETFs or stocks at a price higher than your initial buying price, those aren't imposed on non-US resident aliens like all of us. So yes, while dividends do provide regular income, this withholding tax may immediately turn off some people from investing in anything dividends because it hurts their overall long-term return. And having said that, you might also want to consider investing in island domiciled high dividend yield ETFs, which are only taxed at 15%. Basically the same investment but with half the tax payments. Of course, this is just a simplified version of the entire story. For a deeper dive into maximizing tax savings with ETFs with high dividend yield, check out this video that I've made before. But aside from the financial aspect, your religious principles might also play a role in your investment decisions, and that's totally valid. It shouldn't hold you back from investing though, especially when there are options that align with your Islamic values. And this is where the Shariah compliant investments come in, where the companies or financial products you invest in adhere to Islamic principles. Specifically, Shariah compliant investments avoid businesses that engage in activities considered haram, such as gambling, alcohol, or anything to do with pork. And the good news is, there are tools that make finding these companies easier, like a Shariah compliance screener, where all the necessary data is provided by a third-party company, Elza Sharia Solutions Sdn Berhad, that has also collaborated with renowned local institutions like Bursa Malaysia and also KWSP to ensure that the Sharia compliant stocks and ETFs you identify align with the Islamic principles and your values as well. But if you are after an even simpler approach, you can opt for Sharia compliant ETFs like the HLAL and also SPUS ETFs. However, just keep in mind that Sharia compliant ETFs typically come with slightly higher fees compared to conventional ETFs, as they are specially curated to meet specific religious requirements. So after exploring all these options, it's time for you to choose your ETF. And I have 3 tips for you, especially for those of you that are comparing a few ETFs and unsure which to buy for yourself. Firstly, consider the liquidity of the ETF. ETFs that are liquid are easier to buy or sell, and you can simply just compare the ETFs to see which one has the largest assets under management to know their size. My personal thumb rule, a daily trading volume of at least 1 million shares and above is a liquid ETF. Secondly, check the fees or expense ratio of the ETF. Cost matters when investing in ETFs. It's not just about the fees charged by your trading platform, but also the management fees imposed by the fund company themselves. We all want to minimize costs, so it's important to look at the expense fees listed in the ETF's profile and then compare them to find the one with a better expense ratio which suits your needs. So for this, if you ask me, anything 0.1% per annum or below for passively managed ETFs is a good place to start with. And thirdly, assess the benefits and risks of the ETF. It's crucial to be clear about the benefits and risks of the ETF you are considering. You can use resources and tools like the Morningstar's rating system, which are recognized as one of the industry's authoritative fund evaluation standards, or the indicator analysis to help identify ETFs that are high quality based on their historical returns, beta, Sharpe ratio, etc., all of which I've covered in detail in my previous video, so feel free to check that out. So you have shortlisted and perhaps picked out your favorite ETFs. Great, but where do you actually buy them? Well, ETFs are listed on the stock exchange just like any stocks, so buying an ETF is actually pretty similar to buying any stock on any of your brokerage platforms like Moomoo themselves. And so if you already know which ETF you want, just type the ticker symbol into the search bar, click into the ETF itself, and at the very bottom, hit the trade and also the buy button. I'll make it super easy for you. I'll usually put a limit order type and specify at what price I want to buy this ETF at, just like a stock. So let's say I want to buy 1 share of this ETF at this particular US dollar share price. My quantity will be 1, and session I will just leave it as RTH plus pre-post market, which basically covers all the possible trading hours. Time in force, the simpler one would be GTC or good till cancel, so that I can leave my order open and let it fill itself. And after everything is done, you can click buy, review the trade, and then confirm it. Now, if you ask me, US ETFs, especially the popular ones, should not take too long before it's filled, so it's pretty fast. But what if you are not exactly sure which ETF to go for? So don't worry, there's a simple way to figure it out. When you're on Moomoo's homepage, head to Markets tab. I'll use the US market as an example over here. Look for the ETF option. That's where we want to go. Once you're there, you'll see all kinds of ETFs. Index ETFs that track indexes like the NASDaq 100 and also the S&P 500 index, or thematic ETFs that let you invest in sectors like energy, US Treasury bonds, real estate, gold, biotech, AI, semiconductors, and so on. So let's say I'm really into cloud computing. I can click to that category, scroll all the way down, and there you go. You've got 8 ETF options to choose from to start your research and eventually make your investments in. Now, beyond all of these ETFs, there are ETFs that focus on high dividend yields and even more specialized options like leverage or inverse ETFs. But those are topics we can talk about some other time. Now, when it comes to timing your purchase, that's a question I get a lot. I mean, timing is important, right? We often hear that you make money when you buy, not when you sell. But honestly, trying to time the market is tough, especially when we all have a full-time job. Like, for real, who has time to watch the market 24/7, let alone making the right bet at the right time again and again and again? And this problem, my friend, is where dollar cost averaging or DCA comes in handy. Let's say if you've got $10,000 to invest, instead of dumping it all at once, you could spread it out, maybe invest $1,000 every month for 10 months. Even better, if you believe in the investment itself, just set up a plan to invest a small amount each month, ideally right after you have received your salary for the month. And the key here is discipline. You gotta make sure that you invest every month or every set intervals without even skipping, even if it's rain or shine. I mean, it sounds easy until life gets in the way or the market starts messing with your emotions, like what happened just a while ago in the Japanese market, and the US media goes into a recessionary mood overnight, but eventually recovers much higher immediately afterwards. So there you see, prime example. Sticking to the plan and investing in quality assets is what really matters over the long run. Luckily, many brokers offer recurring investment options that automate the whole process for you. And once it's set up, you can just let it run in the background while you focus on other things in life that actually matter. So, how do you set that up? Well, on the Moomoo app, go to the Markets tab, then look for RSP, which stands for Regular Saving Plan. Click on Create Plan at the top right corner and set up your recurring investment system. For example, if you want to invest in S&P 500 in the form of VOO ETF regularly, search for that ETF, decide how much you want to invest each month, and make sure there's enough money in your account to cover those trades. And you can also choose how often you want to invest. Just remember, the more often you trade, the less you're affected by market timing. But you might also end up paying more in fees lah. And for all intents and purposes, investing once a month should do the trick for you. And that's it. I hope you found this video helpful. If you have any questions, please feel free to drop them in the comments down below and I'll do my best to answer them, or maybe even make a video just for you. Until then, if you're still unsure what are the best ETFs you can invest in as a total beginner, this video is made just for you. See you over there.